a few standards on auditing. I'm sure you have been enlightened since morning on various auditing standards, mainly dealing with reporting standards and the related things. So now in this session, we are going to talk about three critical standards. Two of them relate to audit evidence, and one of them relate to documentation. Now, documentation is a really very important aspect of audit, and I would think that you would agree with me when I say that, this is like many a times a missing piece in the puzzle. So, as an auditor, okay, we are issuing opinion on the financial statements, we are giving our reports, or for that matter, signing a certificate. Now we do a lot of work, but at the end of the day, when the time to test comes, the thing that will be our ally will be the documentation. So there is an age old cliche, and which holds and which will always hold good, is that work not documented is work not done. So especially in today's age where audit profession has been under a lot of scrutiny, with everything going across in the country, so be it the peer review, which has obviously had existed since a long time, then later on QRB came in, and now the NFRA thing. So there is the auditors, I would say, are under a constant lens. But I believe our profession is in a much better shape to face all these challenges, because as an auditor, like the process of becoming auditor, like the process of becoming a chartered accountant is so rigorous that, these challenges look small to us. And plus the amount of, the work or the confidence that has been put on us by the economy or by the users of the financial statements. So say for example, now when you throw up an unaudited financial statements, the shareholders, all the other stakeholders, bankers might not be ready to rely on them. But the moment you say these are audited financial statements, the degree of confidence on those financial statements obviously increases many folds. So time and again, we as a chartered accountant have been asked to prove, that okay, stakeholders are placing trust on you. Are you still, good enough for that trust to be placed on you? And I believe our profession has always stood up to that challenge, and that's why we are still where we are still we are at a stage where we should have been. So yeah, documentation. Speaking about documentation, it matters a lot, because tomorrow, say for example, we have audited our financial statements. Now we did all the audit work as per all the standards on auditing. We performed a risk-based audit. We did a testing on a sample basis. But God forbid, tomorrow something wrong doing of the management gets discovered. Now at the end of the day, how will I prove that I was diligent enough to conduct my audit in accordance with what is written in the standard? So it is at that time that documentation will come into my help. So I have been allotted three standards, SA 500 and SA 501. Now 500 and 501, as you are all aware, deals with the audit evidence aspect of it. But I thought I will start with audit documentation, because that is the most critical of the three standards. Obviously every standard is definitely important, but when we talk about audit documentation, so I feel that whenever you have done or completed a work, but if your documentation is not showing up, then it counts for very less. So say for example, you did a lot of controls testing to say that okay, sales controls are working appropriately, and you have given a report on ICFR. Or very simple example, let's say you have commented on Caro. In Caro, you have commented that company has done the physical verification of fixed assets, but there is nothing in your document, in your file, to prove that such physical verification was actually conducted. Tomorrow you are going to be held responsible, right? So documentation is very critical, is very key. Whenever you are signing, be it an audit report, which is the lengthiest in our country, considering all the opinion on financial statements and the ICFR and the Caro reporting and whatnot, but whether you're signing a long audit report or whether you're signing a small certificate, documentation is very critical, because tomorrow you are going to be asked, you might get asked as to, okay, what is the basis of you saying that financial statements give a true and fair view? At that time, your file should speak for yourself, is what the expectation is. So a basic and a simple test is to have a documentation that fulfills the third party test. Now what is a third party test? So tomorrow you have done work, you have documented it. Tomorrow whenever a question is being asked, your file should speak for yourself, right? So you should not be required to tell what procedure you performed, what result you obtained. So you did an audit of a client, you verified purchases, you verified the controls related thereto. Your file should be strong enough to tell a third party, be it NFRA, be it QRB, be it a peer reviewer, or be it any experienced auditor, to tell that, okay boss, this is what I was supposed to do, this is what I planned, this is what I performed, this is the result I obtained, and that is on that basis I closed off and I signed off in this document. Once we have this watertight document, believe me, nothing can affect us or hamper us. So audit documentation is really very critical. Now before I get into the details of what is written in the standard on auditing, whereas what is written in SA 230, I would like to take a step back and introduce, rather not introduce, you might be all already aware. Let's talk about a concept called as risk-based audit. So these days, we are no longer following a traditional audit approach wherein, long ago we used to verify 80% of sales, 80% of purchases, and probably our work was done. But these days what we do is we follow a risk-based audit. So what I say is we start with the end goal on mind. Okay, what is my end goal? As per SA 200, my end goal is really very clear, that I have to express an opinion on financial statements, that whatever financial statements I'm auditing, whether those financial statements, whatever the numbers are, whatever the disclosures are they true and fair? Okay, so I have to express that opinion. Now there is a risk, right? So say for example, management has prepared the financial statements. Okay, now what is the risk? They might have wrongly capitalized something which is a revenue expenditure. They might have failed to identify a related party transaction. So I start my audit by risk identification and risk assessment, which is very specific to each client. So at the beginning of the audit, what I really need to do is I need to understand the business of the client. Okay, what is the entity's business? Okay, if it's construction industry, I know that revenue is subject to a percentage of completion, wherein the work of architects will be used. So there is a high possibility of bias in revenue. So let me put more work or more efforts on revenue. I do an audit of IT industry. I say that, okay boss, यहाँ पे employee turnover is such a huge, very high. So employee costs, employee bonuses, ESOPs might be something where management might play with, because management might have promised to employees a percentage of profits as their bonus, etc. So they might want to manipulate that number. So I'm not saying that we doubt that, but at the start of the audit, I understand what is the client's business, how good the controls are, right? So on that basis, I identify what we call as what could go wrong. So when you look at the financial statement, even before you start the audit, take a step back, identify the what could go wrongs. Okay, this is the balance sheet. I feel that in this balance sheet, they are having a lot of related party transactions. So there is a chance that some related party disclosure might get missed out. They have a lot of segments and they have a lot of inter-segments transaction. So in segment disclosure might be misstated, right? They deal in a lot of loans, right? They have taken money, they have taken borrowings, and they have given it on loan. So Caro clause 3, Caro clause 9 reporting might be a big challenge for me. If you identify these things right at the beginning of the audit, believe me, you'll have a lot of time to address it rather than them coming as a surprise at the last moment. So risk-based audit approach basically says that your audit is divided into 3 phases. The first one is where you identify the risk, that is what could go wrong in these financial statements, and then you give an assessment. Okay, I'm saying that there is a risk that capital expenditure might be wrongly treated as revenue expenditure. But to counter that, entity says that we have good controls, we have a maker-checker concept, we have a qualified accountant. So you say that, okay, the risk is there, but I will assess the risk as low. Why am I assessing the risk as low? Because entity has implemented certain good internal controls, right? So you reach to a risk ranking as low, medium or high. Once you have done the risk identification and assessment, you respond to that risk. So, okay, I said that, for example, PPE, capital revenue expenditure distinction, the risk is low. But why am I saying the risk is low? Because entity has good controls. So my approach to audit should be to test those controls. Are they actually operating or they just exist on paper? Right? So risk response phase is wherein you plan what procedures are to be performed and then you actually perform those procedures. As a result of these risk responses, you will gather a lot of evidence. And through that evidence, you will come to the third phase, right? The third phase is reporting. Okay, now I have collected evidence. I thought initially I was under the impression that revenue might be misstated, but I've done all my checking. I've done the controls testing, I've done the substantive testing, and I believe that I have enough evidence to say that revenue is true and fair. So what do I report? I say the financial statements give a true and fair view, but it's quite interlinked, and possibly it's never sequentially. It will go in loop, right? You might do a risk assessment, go to risk response, you might again have to revisit to risk assessment, right? So this you will go on in loop. Now why am I telling you this, which is related to SA 315 and SA 330 and SA 700 probably? Why am I telling you this when we are taking a session on SA 230? Because what are we documenting? We are documenting each phase of the audit, right? So this is our entire audit in a nutshell. This is a risk-based audit. You do a risk-based assessment, right? And probably this will gain a lot more prominence because recently, so this is based on SA 315. Now the corresponding international standard on auditing, that is 315, was amended. And there have been talks whereby the SA 315 will also get amended. Now this risk-based approach will remain same, but the new SA 315, which whenever it will come, will have a lot of detailed guidance on how to apply it. So slowly, gradually, even if you are not following a risk-based approach today to the audits of, say, for small clients, you might have to, you have no option but to shift to this risk-based model of audit. And once you understand the risk-based approach to the audit, we understand the documentation also. So, okay, what are the risks that I identified? How did I respond to that risk? What am I reporting? And what is what is on paper to tell me what I'm reporting? So documentation runs through each of the phases of the audit. So in this context, I will get back to the content of the standard, and then at the end we will cover a few practical tips as to what all should be definitely there on the audit file to say that you are complied with standards on auditing in general and SA 230 in particular. So when we take a look at SA 230, it was written many years ago, but it is still relevant, and there has been no need to cause an amendment to this. So my session on SA 230 I have divided into 5 parts, as I just discussed. That we'll discuss the requirement of the standard, the scope, requirement, when to, what are the timelines, deadlines within which I should get my audit file ready, what are the documents that I should always include, and the practical tips surrounding to that. So coming to our first point, the scope of SA 230 is very clear that it applies to all the audits of historical financial statements. Now say for example, tomorrow you are not doing an audit of financial statement, you are doing a review of historical financial statement, in which case SREs will apply. But in that case also documentation is really very important. So in that case the scope gets altered suitably, right? So SA 230 applies whenever you are doing an audit of historical financial statements, and suitably modified whenever you're doing review or other thing on the historical financial statements, right? Your duty, now every standard on auditing starts with an objective. This objective is nothing but the duty assigned to the auditor. So at the end of the audit, if I can prove that, okay, whatever was the objective stated in the essay, 200, 210, 220, 230, each of the standard, if I have achieved those objectives, I have done my audit diligently, then nobody can come and point a thing on me. So what is our objective or duty as an auditor? That I should have a sufficient and appropriate record for the basis of the auditor's report. So whatever I'm saying in the audit report, I'm saying that financial statements give a true and fair view. I should have something on my file to prove why. I'm saying that directors are not disqualified, right? 143(3)(g reporting. I'm saying that directors are not disqualified. What do I have on my file to say that, okay, directors are not disqualified, right? Sometimes it might become that, okay, you have done an oral discussion with the management, but we should not miss out in these things. So basically, a sanity check would be, whenever you are signing a report, take a step back, see whatever you are writing in the report, do you have enough in your file to prove that statement? So when you are saying that directors are not disqualified, it might be a simple case of taking a letter from the directors, right? Or taking a letter from the company. That will serve as a good enough documentation, right? Whenever you are saying in Caro that company has no borrowings, what is there on the file? Obviously, balance sheet mein there are no borrowings. But how do I satisfy myself that there are no unrecorded borrowings? What procedure did I perform to check that, okay, there are no unrecorded borrowings? I checked BRS. There are no items pending, unreconciled items. So all these things, there should be a document. Basically, whatever you are stating in report should be backed up by a document. And also your file should give an evidence that you planned the audit as per those 3 stages, and then you perform the audit. So many a times peer review board, QRB or NFRA, they draw up a comment saying that, okay, you did the planning, you did the execution, but there is no linkage, right? So many a times we as an auditor fail to document the linkage between the planning and the execution. I'm not saying that our planning and execution is not linkage. Please, what I'm trying to say is that our documents don't prove that there is a linkage. So how can we establish that linkage? Okay, this is what I planned, and then this is what I did. Because I planned to rely on controls, then my control testing failed, so I went for more substantive. And that is how I changed the plan, and I did a second execution. So there be a continuous link which is there. Okay. And then, so these are the 2 objectives that that we set to achieve. The other thing in the introductory part of SA 230 is the definition of audit documentation and the audit file. So documentation is defined as record of audit procedures performed. So your document should have what procedures you performed, what evidence did you obtain from them, and what conclusions did you reach. Right? So these are the 3 things should be very clearly evident from your document. And once you collate all the documents in a single place, that is referred to as audit file. Now, so nowadays, a lot of people or a lot of audit firms maintain audit documentation or audit files in electronic form. There are a lot of softwares that are available in the market these days. Now, the standard does not mandate whether you should be going for a physical file or a electronic file, but the firm needs to take a call on this. So basically, it would depend upon various factors such as what are the client base you serve, where the firm is in its growth trajectory, how much is the IT involvement within the firm. So on that basis, each firm takes a decision as to whether to maintain the paper file or the electronic file. But regardless of whether you are maintaining a paper file or an electronic file, cross-referencing is really very important. So say for example, if I'm saying something in the balance sheet that there is this PPE, I should have somewhere back in the file, I should have a document to substantiate that PPE amount, and it should be cross-linked. When I'm saying, okay, PPE depreciation is this much, I should have working paper linked to the depreciation. This cross-referencing is what will help the file to be self-explanatory. So ultimately, whenever you are preparing an audit file, ask yourself one question. This is what I have been doing since a long time now. Ask yourself one question. So tomorrow, if somebody has to read that file, can he read that file without me being present? Is the file self-explanatory? If the answer is yes, then you have passed the third-party test. Okay, so this is what is there in the definition part. Then what all is included in audit documentation, like to make it a little practical. So audit documentation obviously include a lot of things. I've just given a few examples as you can see on the screen. So your audit documentation might include your audit programs. So many a times what happens is you give instruction to your junior in a writing form that, okay, when you're doing audit of trade receivable, obtain the aging schedule, verify the debtors outstanding for more than 90 days, see what provision they have made, verify the cutoff assertion, do this, do that. So those audit programs, which is a series of questions and against which the junior will mark their answer, they'll initial it, constitutes your audit program. Another example, if I just take up randomly, is confirmation letter. Now this is one of the very important piece of paper sitting on the file, because see, whenever we say debtors, creditors, bank balance, the best available evidence is external confirmation. And why is external confirmation so much reliable? Because it is coming from a third party. But there also, whenever you are documenting external confirmation, just keeping that confirmation paper on the file will not serve. So you'll have to tell the story right from the beginning, right? What story right from the beginning? So you'll say that, okay, entity has these many number of bank balances. Entity has these many number of debtors. Out of these debtors, I send the confirmation request to these many. These many are the ones I received, and these are the ones for which I did not receive the confirmation reply, but I performed an alternate procedure. right? So you give a percentage coverage. So let's say total debtors was 100%, selected for confirmation was 80%, out of which I received confirmation from 60, 20 is non-replies, non-responses, for which I performed an alternate procedure, right? And then on that basis, I'm happy that whatever debtor figure is sitting in my balance sheet is appropriate, right? So it is not just external confirmation. Also, what you need to be document is, did you maintain control over external confirmation? Now you cannot ask the client to send the confirmation and or ask the client to receive those confirmation. Obviously the client will send out the confirmation, but the confirmation should have a clear cut instruction that the replies be directed to you, that is the chartered accountant, right? Why so? Because otherwise there is an integrity issue, right? If the client receives a confirmation, he might tamper with it, right? You might never come to know the truth about those confirmation, right? So, and whatever the non-responses are, you should at least have a proof of delivery. So we had a QRB inspection wherein they called for these documents, that okay, you are saying you sent out, you delivered the confirmation, but there were non-responses. How do I believe that you actually sent out those confirmations? So you have this proof of delivery as a registered post. If you're sending it email, there is an email backup or something like that sitting somewhere on your servers, which you show it to them. So everything constitutes documentation, even management representation. Many a times this might get left out. So specifically what I've seen is sometimes we sign a certificate. Now, as a good practice or as a mandatory practice, I would suggest whenever you are signing a certificate also, please back it up with a management representation. So if you are certifying that purchases are so much, sales are so much, obviously it's not my responsibility to account for the purchases. It's ultimately the management's responsibility. They should sign on the representation. I'm not saying that rely only on representation. Obviously you do a testing for purchases, but have a representation on your file. That okay, these are the purchases, this is how it's calculated, and this is based on my books of account. Nothing is omitted. We have given you all the disclosure. So again, tomorrow if something comes up, you have to say that okay, I did my audit procedure and I have representation also. So if the management says that it was incomplete data, you say then why did you sign the representation? So return representations are very important, not only for audit of financial statement but certification also. So these are something that constitutes documentation, and in today's world email correspondence also, because a lot of things might get exchanged over email. So you sending data, the client sending data to actuary, you verifying the completeness of data, you receiving certain replies from the management, right? So these all will constitute the documentation piece. Generally when we look at our audit file, like almost all the firms divide their audit files for each client or each engagement into two files. One is the current audit file and the other one is the permanent audit file. The permanent audit file, as the name suggests, is more permanent in nature. So when you have certain documents like memorandum of association, articles of association, borrowing deeds or property title deeds, you know that these documents are going to be useful for more than one audit. So you keep them in a permanent audit file. Whereas if there are certain working papers like BRS for the current year, you don't keep it in PAF, you keep it in current audit file. Current audit file basically is used to keep only those working papers that have relevance only to the current year, whereas permanent audit file is used to keep the papers of continuing relevance. So say for example, you did a business understanding when you first accepted the client. Now that business understanding document can go into PAF because that will help you in the future years also. You took an organization chart from the company, right? What is the structure? What is the hierarchy? Who reports to whom? What is the authorization matrix? Right, that authorization matrix is relevant not only for this year's audit but next year's also. So you keep those files, you keep those papers in the permanent audit file. Why documentation? So the standard is very clear that before I tell you that you have to document all these things, I'll tell you why to document. So basically it says that documentation is your friend only. I know it might take up a lot of audit time in terms of documentation, but really the trick that some people or some of the junior articles miss is they feel that we'll first complete the work and then do the documentation. That thing never happens. It's like I'll do the studies tomorrow, then that tomorrow never comes, or that I'll start going to the gym from next Monday and I don't know when that next Monday is, right? So the trick that most of the people miss out is not documenting the work simultaneously, right? So point is, whenever you're performing the work, make sure that you are simultaneously documenting also. So you rolled out the confirmation request today, keep a fact, how did you selected that debtors? Okay, out of 100 debtors, how did you select 80 debtors? Keep a piece of paper on the file today itself. Na? So because tomorrow you'll not remember how did you select that 80, or if you did a random sampling, that record might not no longer be available with you. So when QRB on NFRA comes up, they will say that okay, you don't have any basis to say how these 80 were selected. Now whereas genuinely you selected, you did that work. Only thing was you did not document it. So the objective or advantage of documentation is that tomorrow if the QRB or external reviewer comes up, it will be handy. Not only this, so say for example you have prepared a good documentation or a good file for this year. Now next year, let's say you plot a new team on the same client. Let's say a new junior has joined your organization. He can always refer to the previous year working papers and gauge as to what needs to be done in the current year, right? So this will be really helpful, not only at the time of review, but for next year audit also. In fact, why next year audit? So say for example, you asked your article to do certain work, and if he has documented it, now while he's on exam leave or while he's on other audit or while he's on study leave or classes leave or whatever leave, you can go through the file and know, okay, what has been done, what has not been done. So you will be able to keep a track of, what has been done in the audit or where has the audit progressed. So it has a lot of advantages which are there on the slide and which are borrowed from SA 230. One very important question, like this is the heart of the entire standard because this explains the form, content and extent of documentation. So how far should we go? When you say work not documented is work not done. So then do I document each and every immaterial detail? So obviously that is not the thing. But say for example, let's start it this way. So when you were auditing debtors, you saw that management has made a provision for doubtful debts of 5%. Now you did a lot of hard work wherein you checked last 3 years what was the provision for doubtful debts, last 3 years what is the bad debts trend, you analyzed the credit score of the customers, and then you believed, on that basis you believed that okay, 5% is not appropriate. So you went to the management, made an hour-long discussion, and then you both agreed that okay, the provision should actually be 8%. Now at the end of all this, if you are documenting on your file as discussed with management, the provision for doubtful debts of 8% is considered appropriate, you are failing as an auditor because you have done all the hard work, like you have done 99% of the work and you have failed at the last 1%. Because when you say as discussed with the management 8% is appropriate, this would seem to be a cooked up figure. That 8% is not showing the efforts that you did, efforts that you put in to say okay, you analyze the past trends, you discussed with the management, you analyze the credit score. So whatever you are doing, like this cliche, right? If you have it, flaunt it. So if you have done some work, make sure it is coming on the file, because otherwise, it's just like nobody will believe that you actually performed that work. So form, content and extent of audit documentation will be guided by what is the complexity of the area. So say for example, if you are reviewing provision for gratuity, now provision for gratuity involves valuation report from actuary, but I cannot just blindly rely on actuary. I need to see that okay, what data was sent by the company to the actuary. So if I have 100 employees and the company has sent data about 80 employees to the actuary, was that valuation report fails despite actuary being a qualified professional, that valuation reports fail. So you should have on your file that you check the source data, you verified the assumptions. Just provision for gratuity ke liye, if somebody keeps a document called as actuarial valuation report, that is never going to suffice. How did you conclude that okay, this valuation report is something that is reliable? So obviously the institute or nobody is trying to tell you to become an actuary to verify that report, but at least do a basic test, right? Was the source data complete? Were the estimates in order? Were they reasonable? What happened last year? They had taken a salary increment rate of 5%. This year taking 2%. Does things sit with itself? And believe me, once you start documenting, the process will become very easy. If you don't document and if you just think of documentation in your head, it will always appear as a tedious task. But believe me, once you are starting to document, it will become really very easy. It's like thinking that I will exercise, right? So If you don't exercise, it will always look tedious task. But once you start exercising, your body will know the benefits of that, and then your body will ask for that exercise, and you will happily exercise because you know the benefits that flow out of it. So I believe same analogy applies to the documentation as well. So form, content and extent, the standard clearly says that take into consideration the complexity. If it's a very simple area, say for example you are verifying rent, there a simple half page document might also suffice, that okay, as per rent agreement the rent is 10,000 per month, into 12 is 1,20,000, this is what the rent is appearing in the balance sheet, in the P&L, right, and nothing has been missed out. So there, but if for a complex area like fair value estimates, so investments are shown at fair value, or let's say this is the first year where the entity has adopted Ind AS, so they are giving a lot of reconciliation, so there you need to maintain sufficient documentation to prove that okay boss, you have actually verified those numbers, and then you have come to a conclusion to say okay, these numbers are true and fair. Okay, so you should document what should be there in the audit file is NTE, as we call it, the nature, timing and extent of audit procedures. What was the audit procedure you performed, right? When did you perform it? What was your sample size? Nature of audit procedures could be inquiry, observation. We'll look at it in much detail when we discuss SA 500, but these things should be on your file. Also, not only the audit procedures, but after performing the procedures, what did you observe? So you compared the number of employees vis-a-vis the number of employees data sent to actuary. So what was your conclusion? Okay, that source data is correct. So what is my conclusion? That whatever provision for gratuity is there is true and fair. So nature, timing and extent of audit procedures and the results should be documented. What should also be documented, and it is very critical, is this: significant matters arising during the audit. Now when you do audit, there are at times a lot of discussions with the management whereby they have done some accounting treatment, you don't agree or you partially agree. How did you resolve that, right? Because whenever any reviewer comes, he will directly hit on significant matters. So a lot of audit firms have a practice of preparing something called as a summary review memorandum or audit summary memorandum or completion memorandum. I don't know, but what you can call it by multiple names. So what you do in SRM or completion memorandum is basically, okay, during the audit, these were the 5 critical issues. That okay, entity's balance sheet is showing a GST input credit receivable, whereas these has been getting piled up, and recently there has been assessment order wherein a lot of ITC was disallowed. How did I satisfy myself that ITC receivable should still be shown as an asset? This was a significant matter, right? Because there are assessment orders which are disallowing your input tax credit and you're still showing ITC receivable as an asset in the balance sheet. How you say that it is true and fair? You have a patent which is obsolete, you're still carrying it in books at a very high value. Why do you feel that it is the appropriate value? Why it should not be impaired? So these are the significant matters, like what matters took place during the audit, how they were resolved. And ideally this significant matters, this summary review memorandum should not be picked up at the last day. So you should not be preparing that document on the last day. There should be a hierarchy. So okay, article was doing a particular area, he identified these 10 issues, he escalated it to his senior. He said that okay, out of these 4 or 5 issues are very straightforward, the remaining 5 let's carry it to the partner, and all those 5 issues you document as a summary review memorandum. So whatever the queries the articles are raising, your summary review memorandum will come from that. Not all the queries, but filter it out, right? So once you are able to have the documentation in this way, people will actually feel that you have actually done the audit in the sense that it needs to be done. So article identified a query, escalated it to the manager, filtered it out, partner said okay, these are the important thing, this is what I feel should be there on the, as far as this thing is concerned. So it will show that okay, partner was also involved in the audit, so he's not blindly signing on the file, he's not blindly signing on the working papers. So summary review memorandum is really very important. And if you're doing audits of listed clients also, these are the matters out of which you will select your key audit matters, which is again a very important reporting requirement as per SA 701. Now once you have done the execution phase, you have prepared your audit file, the standard is very clear that boss, don't sign the audit report unless you have obtained all the evidence. So if you have not obtained all the evidence, don't sign on the audit report. obtained all the evidence, document only, then you sign the audit report. Now, the standard gives you a certain leeway that, okay, you have collected all the audit evidence in your file, you have all your working papers, but many a times what might happen is that there might be certain old version, right? Old version of the working papers that needs to be discarded. There is cross-referencing to be done. There is final checklist that needs to be printed and kept in the file. All those things are called as assembly, which is basically an administrative process. Now, this assembly of audit file can happen after you have signed the audit report. When I'm saying assembly of audit file, you are actually not performing any audit procedures. Neither are you collecting any audit evidence. It's just that you are bringing all the working papers at one place, cross-referencing them, putting in the file. So as per SQC 1, every firm should have a policy to define a time limit for assembly. But that time limit should not be more than 60 days from the date of auditor's report. So as per SQC 1, you need to have your quality control manual. Your quality control manual needs to state what is the time limit for assembly of final audit file. If your quality control manual says that it has to be assembled within 45 days, well and good, because it is less than 60 days. So the maximum window that is allowed by SQC 1 is 60 days. So it is the time whereby you have to assemble your audit file, and once the assembly has been completed, you need to archive this file. Now, archiving electronically is possible and through records you can show, but archiving basically means that once the assembly has been completed and the file has been archived, no changes can then be made to that file. Okay, so then that becomes locked for that particular year. And that archived file, you need to retain it for a period of 7 years. 7 years from the date of auditor's report or from the date of group auditor's report. So suppose you are auditor of subsidiary and your work is used by the parent company's auditor. You need to retain that file 7 years from the date of group audit report, right? So that is the period of retention that you are looking at. Also, one more important thing that SQC 1 SA 230 talks about is the ownership audit of the audit file. Working papers are your records, right? Client's records are his accounting records. Working paper is, okay, so client's record is purchase book. My working paper is, okay, how do I satisfy myself that this purchase is complete, this purchase is accurate, this purchase is actually existed, occurred, nothing has been missed out, right? So I took a purchase register, I verified 30 samples to say that, okay, but these actually occurred because I have the purchase invoice, GRN, etc. I did a cutoff testing, I did a completeness test, I did accuracy test. So all those will become my working papers. Now purchase record, purchase register might be the property of the company, but these working papers are my property. Generally, you are not supposed to share these working papers with the client because it will make the audit predictable. But many a times a situation might arise. So say for example, this year you prepared a working paper for prepaid expense, now, ideally which was supposed to be prepared by the client, but you prepared a working paper for prepaid expense as to what are the different headings and for which the prepaid expense has occurred, what is the date when it started, when the date it is ending. You might share that working paper with the client so that next year he can keep it prepared in advance. So if sharing of the working paper, but it's obviously at your discretion. So if sharing of the working paper is not undermining the validity of the work, it is not making the audit very predictable, you can share the working papers with the client. Otherwise, you are not supposed to share it because it affects the confidentiality requirement as well. So yeah, so this is basically the requirements of SA 230. Now, one more thing which I should have mentioned at the beginning, whenever you feel there is any question, you please feel free to raise your hand, or we can take it up at the end also. I'm comfortable with both the things, but if at any point of time you feel that there is a question, please feel free to raise your hand and we can discuss and answer. So this was the overview of SA 230 as to what is written within the standard. Now, as I said, some practical tips. So we said that audit is divided into 3 phases: risk assessment, risk response, and reporting. What should be there in my file to say that, okay, I have done these 3 phases? So risk assessment, what we are basically trying to do is, we are understanding the business, we are understanding the internal controls, we are trying to assess, okay, what is the risk that sales might be misstated, what is the risk that PPE might be misstated. So what all documents should be there on my file? So a sample of this thing would be determination of materiality, right? Because unless and until you determine materiality, your audit cannot progress. So materiality, I'm setting a threshold, that was, this is the amount. Below this, I might say that risk, although there is a high chance of this occurring, so scrap sale, for example, there's a high chance of risk occurring, but the amount is way below materiality, I might still say it is a medium risk and not a high risk. Right? But the same error, same control lapse, if I find in sales, I would say it is a high risk because the materiality is huge. So audit team discussion. Now again, this is something also which is many a times missing from the file. Yeah. Disqualification. Yeah. Hmm. 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 Correct. So basically, I'm assuming this is the first year of your audit because had you known that this had happened last year also, you should have planned something well in advance. But if now let's say this is the first year and you are unable to receive the replies from the debtors, so here the standard then tells you to document and first perform obviously the alternate procedure. Okay, so why am I asking for confirmation? Because I want to be sure that this debtor actually exists. So is there an alternate way whereby I can check that this debtor existed? So I go after the balance sheet date. Was this amount actually received after the balance sheet date? This more or less gives me a clarity. It's an indirect way of confirming that obviously because he has paid, then he might have been outstanding. That is why it has paid. It's not a direct relation, but indirectly I get confirmation. Another thing is I can check the sales invoice. So to say that if the sale had occurred, then obviously the debtor would have existed. So we perform an alternate audit procedures. So out of 100 you send confirmation to 80, you receive 20. So out of remaining 60, if you subsequent receipts and sales invoice, if you are able to check for 50, 55, you will say I'm still in a comfortable zone to comment on the debtors. Correct. Correct, correct. And next year, what might happen is so you find out why are they not responding. So you might find out that okay, all these debtors are government agencies. So it is not that they don't want to reply, but they take 3 4 months. So next time for March year end, you roll out the confirmation for December year end itself, right? So at least you will have 9 months ka data which is confirmed, and remaining 3 months is what you will have to do the alternate procedure. That way. Okay. So yeah, so coming back to this documentation, what we were saying is audit team discussions. Again, it is, I'm not saying that audit team discussions don't take place. I'm saying that these are not getting documented. There's a huge difference between. So at the start of the audit, at the start of each audit, we are required by the standards on auditing to have a team brief meeting which the partner is leading, where the partner gives a direction, to the team. Okay, that we are doing the audit of this IT company. I feel that these are the areas where there is a huge possibility of misstatement. I feel that okay, this company has recently gone into restructuring, so employee cost is a problem because a lot of employees have gone into the other company and a lot of their employees have come to our because of the gratuity and all the thing that they want to play with. So we should be very careful with the gratuity provision, employee cost. Because if the partner tells these things right at the beginning to you, you know what is to be done, right? See, as a chartered accountant, if we know the goal, we know we will achieve it. Problem is when we don't know the goal and we start the audit without getting a sense of the entire thing. If we just go and do the routine mechanics of checking purchases, sales, we are doing a disservice to ourselves because our potential is much more than just vouching for the purchase and sales. We are made up of more than that. We have done a lot of rigorous things to reach to this stage. So at the start of the audit, if we can get a fair bit of idea coming from a senior partner that these are the things that you need to look at it, there will be a lot of clarity. Now these things are happening, but many a times these things are not getting documented. So if this document exists on the file, tomorrow nobody can call you that you were negligent. Was how I was negligent when I planned the audit with such diligence and right at the start I targeted these areas, right? Because obviously you cannot hold me responsible to detect each and every fraud. I'm not saying I'll not be vigilant. I will exercise professional skepticism, but you see my file also. I identified high risk areas right at the beginning. I performed a lot of work on that, which is shown in the documentation. So these are certain important things. Also, I would like to emphasize is business risk and fraud risk. So again, larger picture. So say for example, you're doing audit of Vodafone Idea. I'm not sure if I can take names, but if you're doing audit of a telecom company, let's say Vodafone Idea, wherein recently Jio has come up with a huge marketing strategy wherein they are distributing free plans and etc. etc. So when you're doing the audit of Vodafone, there is obviously a going concern risk and there is a risk of revenue overstatement, revenue and profit overstatement. Why? Because Vodafone and Idea might be itchy to show a higher profits to their shareholders. Suppose you say that in the business environment, I know that your business is not doing well. This is a COVID environment. You are a travel company. I know that तुम्हारा business is not doing well. So there is a high chance that your profits might be overstated. Right? You start with that risk in mind. Again, we are not saying that we doubt it, but this is a business risk that. So that is where we say you have to understand the client's business in the true sense. That okay, what are the risk factors that might cause? So something changing in external environment. Let's say you're a leasing company and or let's say you're a company that has almost all the assets on a lease basis and this is the first year of India's 116 leases. You need to be very careful because there might be a lot of misstatements. You might have 15 different types of lease contracts. You cannot account for all of them in the same manner. So somebody needs to do a review of each and every lease contract. Now if the management has done it, well and good. If the management has not done it, you are in for late sittings because now you'll have to review each and every contract. You'll have to see whether the treatment is justified, not justified. But document these things that at the start of the audit, what are the business risk factors that you identified? Keep it on file. Response phase, the documentation. So basically this is just this overview of what should not be missing from your file to show that risk assessment was done. First, obviously, we start with engagement letter, the client acceptance checklist. Okay, why did you agree to continue with that client, right? Meeting with the client wherein you are discussing. So we have a concept called as pre-audit meeting where the client tells you, okay, how this year was. Is there anything new that we have done? Are we going for certain expansion? Are we taking any new loans, etc., etc.? Analytical review, very important. A preliminary analytical review at the start of the audit and a final analytical review at the end of the audit is something that should be definitely there on the file. Audit risk, what are the risks that you identified as per 315, 330? Related party identification, right? At the planning stage itself, if I'm sure that if I'm aware about related parties, then when I'm doing the audit, I'll be vigilant to say, okay, that this is the related party, I need to be careful. The materiality template, because I say that without that the things will not be complete. An audit plan, identifying those risks. Going concern checklist, right? Because at the beginning itself I need to be very clear of these things. Audit team meeting. These are a few documents which should never be missing from the file. And these are the documents that reviewers, regulators are going to come and look. A very simple lapse as engagement letter not existing on a file could create a very bad impression, right? So you might say that, okay, engagement letter was not there, but I completed the audit, I got my fees, I signed the audit report, everybody is happy, but you will be the unhappiest person because now you will be asked a lot of questions as to why the engagement letter was not put on the file. And client might not sign it also on the backdated, he'll not answer your phone, forget about signing an engagement letter. So get these things right at the beginning. Risk response phase, as I said, linkage. What did you plan? What did you perform? What were the results? Was there a need to go back to the planning? How did you supervise the staff? You see, you are relying on the work of article. You can rely. Did you supervise them? Did you give them review comments that, okay, as an article he has checked the audit, he has done the audit of plant and machinery. Did you review? Did you review the PPE schedule to say that, okay, this addition is in plant and machinery, but this should have been sitting in furniture fixture? Right? So staff supervision, working paper review. Again, here what are the documents that should not be missing is audit approach, first and foremost. Are you going for a test of control or a substantive audit, right? If you did a test of controls, how did you determine the sample? What was your results, right? See, test of controls is not mandatory only in case of ICFR. Even in case of non-ICFR clients, I might do a TOC, right, where the business or transactions are voluminous and are process driven. Suppose you are doing an audit of a logistic company, it's an unlisted company, say for example, but all its revenue, the revenue journal entries are all system generated. You'll have a tough time doing a substantive testing. It will be better if you do a controls testing as to, okay, how is the revenue getting recorded in the books? What is the process? Let me understand that process, because if that process has certain flaws, then obviously the output number has also certain flaws, right? And then you verify this certain invoices, etc., etc. But today a lot of smaller companies are also dealing on e-commerce platform, wherein all the records, etc., are automated, right? So in those cases, test of controls becomes mandatory. Sampling criteria, review of related party, right? Journal entry testing, again, this is one thing that is missing from a lot of files. So CFO passing a journal entry to adjust the provision amount is a red flag. Because as a CFO, you should be reviewing the journal entries. You should not be passing the journal entries. If you're passing the journal entries, that means you have an intention to either understate or overstate the profit. So take a journal entry dump. What are the journal entries passed? Who passed them? When was it passed? Right? Were they reversed subsequently? Or a huge, so say for example, rebate to customers. A journal entry is passed without any documentation backup or something, where when you ask the accountant and say that this amount was given by CFO and I just passed the entry, and when you go to CFO, he says that I don't have time to explain you this. You say that obviously this is a red flag. This is just to manipulate the profit. Be very critical of such things, because these red flags, once you spot them, then don't stop. Tax calculation using the work of experts. So these are something that should be there to prove that you conducted the audit as per what was required of you. And then we come to the reporting phase. So yeah, here my common observation would be, I've read a lot of QRB reports wherein they tell us that, okay, what were the shortcomings. So say for example, you are saying that physical verification of inventory was conducted, physical verification of PPE was conducted, clause 1 and clause 2, and you have physical verification report also. What QRB tells is, do you have the instructions which the management gave to the staff for physical verification? Because if that is not on your file, that's a QRB comment in a lot of files, and it's available in the public domain, those comments, that okay, you are saying that physical verification was conducted, you have the physical verification report also, but who conducted the physical verification? Were they competent? Did they know what was to be done? So I should have a simple piece of paper on my file saying that these are the instructions that the management issued to the staff for physical verification. Again, if that document is missing, a lot of chaos will be created, right? So you might feel that, okay, this is burdensome, but this is not burdensome. These things are actually to protect or prevent us only. Okay, changes in materiality. So when you at the start of the audit, you set up the materiality based on budgeted sales, but actual sales were a lot smaller. So then your entire materiality goes for a change. The audit procedure needs to be increased. Again, this is something that is a missing in a lot of places. So some 7-8 documents that should be there on your file is subsequent events review, again SA 560, because there might be some significant events taking place after the balance sheet date but before you sign off on the audit report. So you need to have those things on your file to say that, okay, I've considered those events and these are adjusting, non-adjusting, audit adjustments. So these are basically the journal entries that you proposed or the rectification entries that you proposed. Final analytical review. A preliminary analytical review is done at the planning stage simply to spot the trend. But final analytical review is to say that, okay, boss, is everything fitting in the jigsaw puzzle? So you verified purchases, you verified sales, but at the end of the year, at the end of the audit, you realize that the gross profit is 20%, which is a sharp increase as compared to the last 5 years. Then you say that, boss, something is missing, because the story is looking a little bit incomplete. I verified purchase, I verified sales, I was happy. Individually purchase, individually sales, I was very happy. But now when I'm looking at the larger picture, at the final analytical review, this GP ratio is disturbing. You say that the company earns its revenue on a cost plus basis, which is cost plus 10%, and your net profit ratio is coming to 2%. It's disturbing, right? How can you have a cost plus model of cost plus 10% and net profit showing 2%? I'm not saying that there might definitely have been error, but at least reconcile those things. So you can do the final analytical review, going concern review once again to say that, okay, all the subsequent events have been taken care of. Cross references, as we said, return representation, lawyer confirmation, internal control letter, etc. Right? Internal control letter is a letter of recommendation that you give to the management as a suggestions as to what are the matters or internal controls where you need to do a revisiting. Basically, coming to the towards the end of this particular session, I know that I have taken a lot of time on this standard, but this was a conscious call because uh, if we perform something and not document the whole thing or the whole story of performing it, does not make any sense at all. So yeah, what are the practical tips? So whatever procedure you perform, you document it. Online real-time basis is what my audit partner used to, like my senior used to tell me, that online real-time, because if you don't document now, it will never get documented. It's a myth that you will do the work today and document it tomorrow. It's never getting documented. So same way, like say for example, your client is entering into transactions and not recording it on the day of transaction. Tomorrow you'll forget. You'll miss out on certain transaction. He has spent a lot of money. He has issued a lot of checks, but he has no record. किसको वो check issue किया. After 3 days, the client might not even remember as to for what was the purpose for which this check was issued, and then it will ultimately sit in the miscellaneous expenses, right? So online real-time basis is the way to go about it. Make sure that you fulfill the third-party test, and make sure that there is a constant link between what was planned and what was executed. Okay. Another aspect before we put a stop on this standard is, as an auditor, avoid just in case procedures. Now what are just in case procedures? So say for example, I'm verifying debtors or I'm verifying inventory. So debtors, I've taken a confirmation also. I've seen the subsequent collection also. I've seen the sales invoice also, but I've not verified the provision for doubtful debts. It's an incomplete work, right? So link whatever you're doing, link it to the assertion. So if you're doing all 5 procedure for completeness, but you're doing nothing for valuation, right? So you say inventory, I did a physical verification, I attended, I did the RECO, but you did nothing to compare the NRV with the cost. So you're going wrong on. So whenever you're doing an audit procedure, don't just say that, chalo, ye, just in case, let's do this procedure. Ask, what is the assertion we are trying to achieve? So what used to happen at our firm when I was a junior was, whenever I was performing a procedure, my partner, we had a clear instruction that you need to write in bracket what is the assertion you are verifying. If you are not writing the assertion, don't perform the procedure, don't start the procedure till you know what assertion. Because then it gives the holistic approach that okay, all the assertions are getting covered. I'm not only looking at completeness, valuation. So if I just do a sales register 80% checking with the sales invoice, it's an incomplete work because you have just checked the occurrence of the sales. You are not sure about the cutoff. You are not sure about the completeness. You took sales register as a base, right? And you said that okay, sales invoice exists. But what if the sales did not get recorded in the sales register only? How would you find that? You will not find that by looking at sales register. You'll have to go a reverse way. You'll have to do a scrutiny of the stock, or you'll have to do the scrutiny of the shipping documents. So be intelligent enough to perform the procedures that are value adding. Not all procedures would be value adding. So don't do just in case procedure. Let's just perform these procedures and see what happens. No, we don't see what happens. We think we know what is going to happen, and then we perform that procedure and we see the result. So make sure that these things are there. Use checklist, right? Communicate the findings of cold file review. Now within your firm, you might have a concept of cold file review where after the audit season, partners look at the file of each other and say that okay boss, in your file this is missing, in my file this is missing. Communicate this within the firm, right? It's internal, but it will help you grow. That okay, this is something that I missed out, this is something that you missed out. Next year let's see that we don't do these, we don't repeat these things, like a combined learning kind of a thing. Take advantage of technology wherever you feel that electronic documentation can be done. You go for it if it saves time. But don't do electronic documentation just because it looks fancy. So see what fits your organization. Okay. So then we talk about is SA 230 till now. Any questions? We feel free to ask. I know we have a limited time or a time res- Yeah. Hmm. 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 Okay. Hmm. 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 Correct. So we do our work diligently to first say that whether they are related parties. Because if they are no, because see, we might know if they are related parties. Hmm. Hmm. Right. So we document that. How did we justify that they are not related parties? What was the business rationale? Was the goods actually delivered? We check the subsequent receipt. Take a representation. Hmm. 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 In the previous year. Hmm. 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 Right. So this is basically a clear cut case of disagreement. So if you don't get enough evidence on file, the last option would be to qualify the report, or at least say that okay, except for debtors we are giving an opinion. So here first try and get the audit evidence about the recoverability or whatever has happened in the past. If it makes you suspicious that this is not a genuine business transaction or this is something to cook up the thing, you might resort to qualification, whereby you say that okay, I don't have sufficient appropriate audit evidence, so I am qualifying. So this in fact takes us to our next topic, which is audit evidence. Now, audit evidence is basically the results of whatever procedure you perform. And this is the thing on which you are going to base your audit opinion. So your audit report cannot come to life unless you have audit evidence. It is not just information, it is right information from right source, as they say. And it needs to have two qualities, or rather two adjectives are always associated with it. One is the sufficiency and the other is appropriateness. Now they are not compensatory in nature. So sufficiency basically tells us that you should have enough evidence and the quality should be there. So say for example, when I said you verified 80% of the sales from the sales register, you have sufficient evidence, but you don't have appropriate evidence for completeness. So you have evidence for occurrence assertion. So you have evidence on your file to say that this sale has actually occurred. But do you have evidence on file to say that a sale that occurred but is not recorded? You don't have anything that. No? Because if there are unrecorded sales, you are not going to find it in the sales register. You have to look at somewhere else. So sufficiency is there, but appropriateness is not there because you're not covering all the assertion. So so basically, what we are trying to say is your audit evidence that you obtain from audit procedures should be sufficient as well as appropriate. Sufficiency is a measure of quantity, whereas appropriateness is the measure of quality. Audit evidence is to be distinguished from accounting records. So books of accounts are accounting records, but your working papers are audit evidence. Many a times those books of accounts will also be served as an audit evidence, like sales register is a piece of evidence, contract is an audit evidence, but audit evidence is generally a broader term wherein a lot of accounting records will come, but your working paper will also come. Okay, many a times your audit evidence might be based on the use of work of others, Now, these others could be either a management expert or an auditor expert or an internal auditor or component auditor. So there are different standards that deals with it. Whenever you're using the work of an expert that is appointed by the management, so say for example actuary for provision for gratuity liability valuation, he's a management expert. The work will be covered under SA 500. But if for example we are talking about using the work of internal auditor, right, 600 series will apply. You're using the work of expert, 600 series will apply, right? So management expert is covered under SA 500. Your audit evidence, if you don't have sufficient and appropriate audit evidence, you can't give an unmodified opinion. So unmodified opinion, basically in other words what I'm saying is you can only give when you have sufficient and appropriate audit evidence on your file. So say for example you are not able, like there is inventory. Now you did not attend physical verification of inventory. There is no alternate procedure whereby you can confirm, and inventory is material, right? Now depending on whether or not it is pervasive, you either give a qualified opinion or you give an adverse opinion, because you don't have evidence, right? So you give a qualified opinion or a disclaimer of opinion, or wherein you have the evidence to say that okay it is misstated, you give a qualified opinion or adverse opinion, right? So qualified adverse opinion is something that you give when you know that financial statements are materially misstated and the effect is material as well as pervasive. If it's not pervasive, you give qualified. Disclaimer of opinion is something that you give when you are unable to obtain sufficient appropriate audit evidence. Like in her case, if she is not able to get evidence about the recoverability of the debtors, she might think of giving a qualified opinion or a disclaimer of opinion. So if the matter is pervasive, right, it almost eats up your entire balance sheet, then a disclaimer of opinion would be appropriate. So say for example you are auditing a consolidated financial statement and the company has only one subsidiary. Now you don't have anything regarding that subsidiary, so you don't have sufficient appropriate audit evidence, and this matter is pervasive because when you are consolidating subsidiary, it comes in assets also, liabilities also, income, expense, everywhere it is coming. So you might be forced to give a disclaimer of opinion, right? But if let's say you don't have evidence for one line item which is inventory, now it is material but it is let's say 5% of the total balance sheet, you give a qualified opinion, right? So whether you have obtained or not obtained sufficient appropriate audit evidence will determine what kind of audit opinion you end up into. Let's take a quick look at sufficiency and appropriateness. So sufficiency, as we said, is a measure of quantity, how much of the evidence. So this is directly related to your sample size. And appropriateness is a measure of quality. It is basically the relevance and reliability. So when you are doing a physical verification of inventory, you are getting an evidence that is relevant for existence assertion, but that might not be relevant for valuation assertion. So you have appropriate evidence for existence but not for valuation. Reliability of audit evidence will depend on how did you obtain that. Like say for example source. External confirmation would generally become as more reliable. Why? Because it is coming from a third party. But say for example when the third party is a related party, you might have doubts over that reliability. Internally generated documents would generally be less reliable as compared to external documents. But if the internal controls are strong, then that reliability of internal documents also increases. So what is reliable, what is not reliable, you take a call based on the facts of each case. But make sure that you have evidence that is relevant as well as reliable for it to be called as an appropriate audit evidence. Okay. How much evidence is sufficient? So let's say you're doing audit of sales, and in the planning stage you said that sales is high risk. Now in the planning stage, if you're saying sales is high risk and you're getting evidence of a sample size of 5%, boss, it is not sufficient. It does not justify it is a, okay, if it's a high risk, then you need more evidence, right? So risk of material misstatement, if it is higher, then more evidence is required. And what is the quality of evidence also? So sometimes if the quality is very good, some extent if the sufficiency is compromised might be taken care of, but reverse might not work. So you have obtained a bulk of evidence like 90%, but still the quality is not there, it will not suffice. So these are interrelated concepts, as we say. How do we obtain audit evidence? By performing audit procedure. Basically the standard SA 330 divides the audit procedures into two categories: the risk assessment procedures and the further audit procedures. The risk assessment procedures are basically those whereby you identify and assess the risk. Like we said, what could go wrong? So when you are trying to assess whether sales is a high risk, medium risk, low risk, you did a trend analysis of last 5 years. What is the sales growth? You did inquiry into internal controls. So these are risk assessment procedures. Further audit procedures are, okay, I'm saying that, okay, sales is a high risk or sales is a low risk because controls are good. Let me test those controls. Or substantive procedures, which includes your vouching. Whatever audit procedures you are performing, these are our like 7 tools, I would say, to gather audit evidence. These are the tools, techniques that you will always be using. Inquiry, inspection, observation. You would have heard about them. Let's pick up a few. Like inquiries of the management will tell you, okay, what are the internal controls, but we cannot just rely on inquiry. So if the management is saying there is an internal control, internal control is preparation of BRS, then you actually need to inspect the BRS to say that it was actually prepared. Or you need to do a observation, like physical stock being counted. So inquiries are to be ably supported by inspection, observation, and these are the ways in which you can obtain audit evidence. When it comes to sufficiency, how do we select the sample size? Now, here also the standards allow us 3 approaches. One is 100% testing. So say for example, when you are verifying debtors and you have 5 debtors and all 5 are related party, you might say I'll send the confirmation to everybody. So that is 100% testing. Or when you are not doing 100% sampling, then the thing that you can do is you can do a bias sampling. So say for example, other income, you select the top 10 items, right? And you say that, okay, if top 10 are good, I am good. The last one is audit sampling, which is statistical sampling, right? Where there is no bias involved. Each item has a chance of getting selected. So generally when we are doing a test of controls, a bias sampling will not work, because if the controls are operating for a high value transaction, it should operate for a low value transaction also. But when you are doing audit of items such as other income, etc., there your bias sampling might be appropriate. What the reviewers also look at is, okay, what was the basis for your sampling? Why did you go for selective sampling? Why did you go for statistical sampling? Is what is the answer to be given at the end of the day to the reviewer. SA 500 also talks about using the work of the management's expert. Now, whenever using the work of management experts, so say for example, actuary, you need to be very clear about his competence, capability and objectivity. Does he have a professional degree, etc. You obtain his work, understanding of his work. What are the source data he used? What are the assumptions he used, right? So all these things will be very relevant to our area of work to say that, okay, we are relying on this thing. And whenever there are any doubts, so say for example, you have doubt about the reliability of the representation or reliability of the confirmation, document how did the doubt arise and how did you resolve that. That will be very, very critical. And if the doubt pertains, you say that, okay, I'm giving a disclaimer of opinion or qualified opinion. This basically then takes us to SA 501, which is audit evidence for specific consideration for selected items. Now here what we are basically saying is 500 was generic. It says that you need to obtain audit evidence for everything sitting in the balance sheet, P&L notes. 501 tells us that I would elaborate on SA 500 principles for these 3 areas. One is inventory, the existence assertion of inventory. The second is litigation and claims, the completeness of that. So many a times what will happen is you might see that, okay, entity has disclosed 4 cases as contingent liabilities. But what if there is a 5th case? What if there is a 6th case and the entity has not disclosed it to you? What will you do to say that, okay, there is no 5th or 6th case? 501 will guide you. And the last one is segment information. So let me use this slide itself to explain the concept of SA 501. So basically what we are saying here is when it comes to inventory, the best way to obtain evidence for existence and condition is you attend the physical verification. And this is mandatory. See, as an auditor, you might decide that you don't want to, you don't want to attend a physical verification of PPE. But if there is inventory in the balance sheet and the inventory is material to the financial statements as a whole, then as an auditor, SA 501 makes it mandatory for you to attend that physical verification. There is no escape, not only for Caro but for the inventory existence and condition. So what you are supposed to do is plan your attendance, make sure that the management has given instruction to the staff, do a test check while you're there, inspect the condition of the inventory. Why? Because if you inspect the condition of inventory, you might know whether the NRV has deteriorated, not deteriorated, etc. The second is litigation and claims. Here we are talking about the completeness assertion. So there is always a risk that there might be some litigations or claims that are not shown in the books only. So here what the standard tells you is go through the legal fees account or legal expenses account of the client. See if they have paid fees to the lawyer, they would have paid it for certain case. That is how you can find out. Speak to the in-house lawyer, right? We saw one of that as a document also. Speak to the in-house lawyer, seek representation from the entity's external lawyer, seek a meeting with them, right? So this is how you can verify the completeness of litigation and claims. And the last one is segment information, which is wherein you verify the assertion for presentation and disclosure. So segment information would be prepared either as per AS 17 or Ind AS 108. Now obviously it is the management's responsibility, but as an auditor you obtain an understanding of the process as to how did they identify the segment, like were they consistent with the standard. So AS 17 gives you a 10% criteria, same way Ind AS 108 gives you a 10% criteria. Understand their process and see whether they are in compliance with the standard or not, and whatever the policies they have used for identification of the segments, are they consistent. If they have used certain policy to show inter-segment transactions, are they consistent with the previous years or not. So this is SA 501, which is very specific, but that does not mean that you need sufficient appropriate audit evidence for only these many assertions. It is just that for these specific items there are certain considerations that you need to keep in mind. And with that I would say that where the inventory is. So we see whether we can take an expert help as far as that is concerned, because the standard allows you one ground, that it is if it is impracticable to attend physical verification of the inventory, but then impracticable has to be something that is really impossible. But if the material is in bulk, that itself might not be an excuse. So what you will have to say. Correct. So here what we can do is we can take certain planning considerations into mind and say that okay, what is the total value of the scrap that is appearing in the financial statement, right? Quantity wise if it is very high, but value wise it is very small, I can get a materiality leeway, okay, that it is not material. But if we are saying at the end of the day it is material, I first need, sorry. Okay, sorry, I did not hear that. So then it will definitely there is no other way out apart from physical verification. The physical verification has to be done. So you deploy experts, you take help of either management expert or something like that. But unfortunately, I would say there is no leeway under the standard. What I would also suggest is, say for example, I agree with you that the steel raw material quantity is very large. Now you first, before you go to physical verification of the inventory or physical verification counting, you establish as to what are the entities inventory records, are they maintained on a timely basis. So you prove that on file that they are maintained on a timely basis, purchases are recorded, consumption is recorded. So you prove that internal controls are strong. And on that basis you say that because internal controls are strong, I attended the physical verification and I only verified a sample as a cross check. Management did a full physical verification, but I as an auditor verified a sample. And what was the reason to verify a low sample? Because the internal controls were good. But there can be no grounds of not attending the physical verification. within when you're once you're attending the physical verification, it becomes really very important to it might be possible to reduce your sample size, but attending is a must. Yeah, yeah. Hmm. 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 Okay. Lying in the stores as well. Hmm. 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 Correct. Hmm. Hmm. So that is where I think that recent Caro amendment takes a very important precedent, Caro clause 2B, wherein you are required to say that okay, whatever is your so if you have taken a loan from bank on the basis of security of current asset, what was the stock statement did you say that you submitted to the bank, and what is there as per your books. If they are not tying, there will be a Caro qualification, and even the management is required to explain that. So I think that will help them. If you tell them this, they'll stop it immediately because that's a Schedule 3 disclosure also on that point. Okay. Hmm. So this is a material amount. So you highlight that this needs to be disclosed as a part of Schedule 3. The reasons. Hmm. So here SA 501 will, sorry, 510 will apply, wherein you say that initial audit engagement opening balance, because yes, you have a reason to believe that opening balance might be misstated. You you say that okay, whether it has an impact on the current year's FS also, and then it might result in a qualification in line with SA 710, whereby you are reporting on the comparatives also. So both these standards needs to be kept in mind. Any other questions? We are welcome. I'm sorry I had to rush up the last standard, but I thought I would rather wind it up on time than extending it. Any further questions? We feel free to ask. Okay, then, sir. I think that will be it. Thank you so much for your patient hearing, and thanks for all the queries. It's a privilege. Thank you.
Thanks a lot, Kumarji. It was really an informative session on audit evidence and audit documentation presented by you. I request everybody to give loud applause to Kumarji. I also thank every participant for making this seminar successful. Thank you.